Tom, welcome. And what's your reaction to the Fed's move here?
Hi, Kelly. I'm incredibly impressed. I've been impressed with how fast they're moving, the scale with which they're moving, and now, to your point, the scope. They're widening their footprint into high yield. The most important caveat really was that they are going to
Tom, 1 second. We're just going to have you restate what you just said. The most important caveat is
to handle up nearly 20. I'm sorry. The caveat is the fallen angels discussion.
Yes.
The Fed today is announcing that they are going to support names that get downgraded from IG into high yield. Example today is Ford. Ford 31 bonds are trading 20 points higher on the day.
What would your advice to investors be now?
I think you have to acknowledge that there's a new player in this market. High yield has lagged the rally we've seen in equities for the last 2 weeks. So one of these markets had it to correct. Either equities would have to settle lower or high yield would rally. I think given this rally we're seeing now, you defensively step in. Double Bs look attractive and crossovers, given that the Fed is going to be involved in that part of the market.
Do you worry about how long they stay involved and how long to hold these bonds?
Yes and no. I mean, yes, meaning that I don't think they want to have a big footprint in high yield on a go forward, Kelly. But Powell said it today, and as you know, I spent a lot of time with these guys. They're not going to be in a rush to the door. We should assume there'll be players and active in this market for a long time.
Which has some people worried. I mean, they're going to be exposed to credit losses that the Treasury will ultimately have to backstop. There's philosophical questions this raises and so forth, which is why sometimes it's nice to talk to the practitioners who kind of don't have to worry about that. I mean, the message that most people seem to be taking from this is it's a game on for credit, basically, of all stripes, and ultimately for equities, right?
Yeah. Yes. I mean, in some regards, the Fed is making it very clear to us that they are not going to let liquidity problems cause insolvency. So when I look at this situation we're in with COVID, we have two problems. The economy is going to be very challenged, and we should not ignore that. But the liquidity crunch that we were experiencing for really 3 to 6 weeks, the Fed has really stepped in and actively told us this is not going to be an issue. And they are pointing liquidity into places that they've never been to, municipals, high yield, investment grade. So they have the ammunition to do it.
Yeah.
Kelly, one thing to also acknowledge, this feels like they're doing a lot. They've only levered up half of the roughly $500 billion that is in the Exchange Stability Fund that the Treasury's put in there. So they have more they can do.
Yeah. This is just half of what could be coming at us, and it's an incredible amount already. Tom, thanks. We appreciate it today.